Inflation had a surprise uptick. Rates and bonds wobbled a bit, and stock markets, especially many of the biggest stocks, perform well yet again. The chance of recession is dropping but still exists, and it wouldn't be surprising if there were more volatility on the horizon since stock markets have been so strong for so long now. We'll cover that and more today in the WealthStep Quarterly Context webinar for the first quarter of 2024. WealthStep is an online financial guide to help 401k plan participants and other individuals make smart decisions about how much money they need to retire and how much to save and how to invest now to get there. These webinars are designed to make economic and other information approachable, high-level perspective regarding the economy, markets, and investor behavior patterns to help you stay more relaxed by staying informed and make better decisions towards your goals. We'll keep this presentation to about 15 minutes or so, and recordings will be put on the blog at wealthstep.com. Pass it on to people to help them achieve retirement readiness as well. There will also be two parts to the presentation. The general quarterly context, and then a quick review of key steps to achieve retirement readiness and financial independence. Of course, we always try to remind and focus on the idea of aim, save, and invest. Those are the key three things that if you do them right, you will end up in a place with lots of great options for your financial flexibility and retirement options in the future. As a reminder, we always encourage people to focus on the space between the things that matter and the things that you can control. There may be lots of things that matter to you. Some of them are controllable, some are not. When it has to do with economic and investment market topics, for example, you can't control the stock market, the bond market, inflation, unemployment statistics, and so forth, but you can control how you respond to them, how you save consistently, how you become and remain a disciplined and consistent investor over time, and those are the things that help you get where you want to go. The first section then, we'll focus on some updated information. There are always news elements during the course of the quarter or a year that may cause the market to bump around a little bit, but in the long run, any individual news element doesn't hold too much weight. In terms of macro level metrics, we're still coming out of a period where there were 11 consecutive rate hikes, the fastest and steepest set of rate hikes in US market history. When rates go up, federal funds rates go up, bond rates go up, and bond prices go down. So that led to some weak bond years, but that we're now in an environment where rates are leveling out and are expected to come down at some point on the horizon. Inflation has cooled from about 9% in the middle of 2022 to about 3.2% now, and the Fed would still like to see that come down closer to 2%. Overall, the stock market was strong in the first quarter of 2024, and the bond market, given that rates have not come down as fast as investors hoped, and the Fed signaling that they would leave rates higher to make sure that inflation is under control before rates are brought back down, had led to a slightly negative bond market for the quarter. Overall, unemployment has ticked up a bit, and overall growth of the economy came down a little bit, but the prior quarter's 4.9% was unusually high, and the projection for the full 2024 from the Federal Reserve estimates is at about 2% for 2024. Stock markets, again, were strong for the quarter. US stock markets up about 10, international up 5.5, emerging markets about 2.4. Real estate cooled a little bit. The US bond market, as mentioned, cooled a little bit, and the global bond market was positive. You can see over the course of the 1 year, 5 year, and 10 years, some rather strong numbers here. So despite having the COVID environment and the rate hike environment, while there's some areas that were weaker and bonds are going to take a while to get returns back up now that rates are higher, a number of stock market areas have been surprisingly strong, higher than long-term averages. And so it's a good reminder that even if there are bumpy times, if you hang through them and stick with it, you can achieve solid returns towards your long-term goals. So volatility is normal. In the long run, it pays off to have some of that exposure. Stocks, if we look at this, different time periods for different parts of the US stock market, if we look since the bottom of the market in March 2020, very strong returns across the board. The largest have been in the large cap growth, and within that, the mega cap growth, the very biggest companies have done the best. But some would say that those companies may have valuations that are a little bit stretched, and those that have had weaker returns since then may be poised for stronger returns moving forward relative to some other companies. What's going to happen with the economy? Economists are decreasing their projections of the possibility of a recession. However, it's still some chance of that, given that the Fed is holding rates relatively high to make sure that inflation is reined in. Holding rates higher cools the economy, and part of that attempt to try to cool inflation. Higher inflation in the long run can be very damaging to the economy and to jobs, and so the Fed is trying its best to control things now so that there's a more positive long-term future. There are some questions, however, even though the economy is relatively strong, although not all, depending on income levels, not everyone feels like the economy is as strong as it is on average. There's questions about inflation. There's questions about lending having slowed. That's a sign of a cooling economy. And the higher rates have not fully flowed their way through the economy. That can take a while to have its full effect. Overall, inflation has been hovering stubbornly around that 3% mark, whereas the Fed wants to get it closer to 2%. Oil has been one of the bigger drivers of some of these more recent inflation numbers, both on going up and also coming down. You can see the pattern is similar here to the overall inflation number. And the projected rates by the market, the bond market, and the Fed are very similar until we get out about a year from now, where the market believes that the Fed will not lower rates as soon as the Fed is forecasting. When this has been an interesting couple of years for bonds. Bonds are usually the boring part of the market, and the stock market is usually the more interesting and exciting part. But with rates having gone up, that led to a tough year in 2022 for bonds, down 14%. Very unusual that that would happen. But after some bumpy months, then the expectation that rates would cool down led bonds to get a big jump, about 8.5% return towards the end of last year. That led to a very positive return for bonds overall, making up some of the weak prior year's return. And there's still more recovery to go once rates start to come down. In the meantime, with the uncertainty about the timing of rates, there's been a flat month, a negative month, a positive month. And so this is normal for the bond market to sort things out, waiting for the Fed to make its move. As a reminder, if you have a lot of money sitting in your savings account, checking account, or a sweep account at a brokerage firm, you're probably earning almost zero. So if there's money that you might need in the next few years, but don't need immediately, it can make sense to put that into a money market, which is currently paying closer to 5%. As rates come down, as mentioned before, that's projected, money market returns will come down, but right now around 5% is quite a solid return with essentially no risk. So it's a way to add a little boost and beat inflation rather than losing against inflation by having a 0% rate in your checking or savings account. Now we'll do a quick review of key concepts towards retirement readiness. It's always important to keep the perspective and focus on things that matter. We'll cover a few topics here. One very basic is AIM. That's to try to focus on what your goals are, when you hope to retire, how much money you might need, and the general rule of thumb is to save at least 10 to 15%, especially if you start in your younger years. If you waited to save until your mid-30s or 40s, you might need to save more in order to catch up if you want to have the same lifestyle that you have now. And then investing is should be the simplest part for most 401k plan clients or those that have an advisor, because unless you're doing it yourself, it can be rather complicated. But if you're in a 401k plan that has pre-built portfolios, a lot of the work there is done for you, so you can focus primarily on saving. We see a pattern over time of 401k plan participants and other individuals by age. The younger people are, the more they defer the decision and decide to save later, but then later in life, they really wish they had saved sooner, especially when they increase their understanding about the power of compounding. The earlier you save, the more it grows, and especially if you're investing reasonably wisely, and has a big impact in the long run in terms of the cumulative impact of returns over time. So one of the best things you can do for yourself is try to imagine what you might think in the future, or ask people that you know that might be an older age than you, and say, you know, what do you wish you had done about your retirement plan saving? And what we see is that almost everyone says, I wish I had saved more and sooner. Stock markets are and bond markets and cash are the three primary investment types of vehicles. So we've got small companies and large companies here. And as you can see, in the long run, those stocks in general do much better than bonds, which do much better than cash. Here's the thing, and this is critical to making smart long-term decisions and feeling comfortable with some short-term volatility in markets, is that you can see the stock markets are quite a bit bumpier along the way. This is over about 100 years. A lot bumpier along the way can make people nervous. So some people hold their money in cash or bonds instead, but not realizing how much return they are giving up. And if you do that, it just means that to get to the same place, you have to save an immense amount of money more than you would if you had a portfolio that includes both stocks and bonds. And the right mix depends on your age, and we can talk about that in a moment. But remember here, then cash, it barely beats inflation. And by cash here, we're talking about something like treasury bills or a money market, whereas if you're just holding regular cash in a savings account, it would be more like this baseline line here, which means you're losing against inflation every day, and that is setting you back rather than even staying pace with inflation, let alone keeping up. So if you want to beat inflation in the long run, you have to invest in things that tend to earn more than the rate of inflation. Studies show that people who do react emotionally to volatile markets tend to have worse returns. In the long run, the stock market, as one example, about an 8% return over a 20-year period recently, whereas the average investor had about a 4% return. And that was primarily because of people moving in and out of the market because they were worried or excited rather than just sticking with it. There aren't that many opportunities in life to just do nothing and end up in a better place. But this is one where if you have a properly diversified portfolio and you stick with it, you will tend to do much better than investors who are moving things around all the time. In the future, the advice component of WealthStep will be launched, which will provide planning and saving advice, investment advice, which is basically around investing wisely by life stage. And there are educational videos similar to this one and more expanded if you would like to view more videos now and sooner. There are multiple levels of WealthStep services for 401k plans, for those that don't have a 401k plan and want access to the same type of tools and education and investing and so forth. So with that, we hope this was helpful for you. Remember to aim, save, and invest so that you can spend the amount you need and want during your retirement years, and then be sure to spend wisely and within your means. And in the full education video, there's some discussion about some ideas around how to estimate how much you can spend sustainably over time without running out of money before you run to the end of your retirement. So thank you very much for joining us today, and we wish you well.